Hey everyone, welcome back to FluxFolio Finance Channel, your go-to spot for decoding the biggest financial shifts shaping your world. Today, April 25, 2025, we're diving deep into how U.S. Treasury Secretary Scott Bessent, the IMF, and the World Bank are steering global economics, from the legacy of the Bretton Woods system to the new Mar-a-Lago Accord that's shaking things up. We'll explore what this means for the U.S., China, stablecoins like USDC, Bitcoin's wild run to $109,079 on January 20, 2025, and even the energy sector, think oil, electricity, and nuclear power. Let's keep the momentum going, so hit that like button, subscribe, and let's jump right in. First up, let's talk about Scott Bessent, the U.S. Treasury Secretary who's been making waves since his appointment on January 20, 2025. On April 23, 2025, Bessent spoke at the IMF and World Bank spring meetings, urging these institutions to refocus on their original missions to better serve both the U.S. and the global economy. He emphasized promoting international monetary cooperation, balancing global trade, and tackling trade imbalances, specifically calling out China to shift from export-led to consumption-led growth. Bessent also warned against supporting entities tied to the Russian war machine, showing the Trump administration's push to align the IMF and World Bank with American interests like job creation, energy policy, and reducing lending to competitors like China. So, what exactly are the IMF and World Bank, and why do they matter so much for the U.S. economy? The IMF and World Bank were born in July 1944 at the Bretton Woods Conference, a system designed to foster global economic stability after World War II. Back then, currencies were pegged to the US dollar, which was convertible to gold, and the IMF helped countries manage payment crises while the World Bank funded development projects. This Bretton Woods framework ushered in a golden age of capitalism in the 1950s and 60s, but it collapsed on August 15, 1971, when President Nixon ended the dollar's gold convertibility due to trade deficits and a run on gold reserves. That shift to floating exchange rates marked the rise of financialization, with private banks gaining power, and critics say the IMF and World Bank started pushing a neoliberal Washington consensus of privatization and austerity, often prioritizing corporate interests over public welfare in developing nations. Fast forward to today, April 25, 2025, and the U.S. is now driving a new economic strategy called the Mar-a-Lago Accord, which we first discussed on March 15, 2025. Unlike Bretton Woods' focus on global cooperation, the Mar-a-Lago Accord leverages uncertainty, like trade wars with China or geopolitical tensions, to scare other countries into buying U.S. treasuries as a safe haven. This lets the U.S. cut interest rates, print more dollars to pay off maturing treasuries, and buy up global assets at low prices during a crisis. Since February 1, 2025, the U.S. Treasury has injected $510 billion into markets by drawing down its general account, fueling liquidity that's boosting assets like Bitcoin, which hit $109,079 on January 20, 2025, though it's now at $69,824.68 as of April 23, 2025. So, how do the IMF and World Bank fit into this new strategy, especially for the U.S. and its rivalry with China? The U.S. holds just under 16% of the vote at both institutions, giving it major influence to push its agenda. For the U.S., the IMF and World Bank stabilize global markets, ensuring demand for American exports. 40% of S&P 500 revenues come from foreign markets, and export-related jobs pay a 20% wage premium. The IMF's crisis prevention, like its $30 billion in zero-interest loans to 50 low-income countries over the past 4 years as of 2024, reduces global financial shocks that could hurt the U.S. economy. But Bessent wants more. He's pushing the IMF to force China to rebalance its trade, reducing its export surplus and increasing imports, potentially from the U.S., which could channel money back to American businesses. Now, let's talk stablecoins, because they're a key piece of this puzzle, tying crypto to U.S. economic power. Stablecoins like Tether's USDT and Circle's USDC are pegged to the dollar, used for payments and trading in crypto markets. As of April 23, 2025, Tether has a $140 billion market cap and holds $106 billion in U.S. treasuries to back USDT, while USDC is also a big treasury buyer. This means stablecoins are directly supporting the Mar-a-Lago Accord's goal of boosting treasury demand. Posts on X from March 22, 2025, note Tether's 400 million users are bridging crypto to U.S. debt, creating a liquidity surge that's lifting Bitcoin, Ethereum at $1,581.56 as of April 23, 2025, Solana at $124.57 on April 16, 2025, after hitting $210 on July 31, 2024, and XRP at $2.40 as of April 23, 2025. But the IMF and World Bank can do even more to redirect money flows to the US or Treasuries, especially by adjusting who they lend to, or don't lend to, particularly in a crisis. They could promote stablecoin integration into global finance, as the IMF has shown interest in digital payments at recent meetings, increasing Treasury demand. The IMF can also use loan conditions to push countries like China to import more from the US, while the World Bank could fund projects that benefit American firms, like infrastructure using US tech. In a crisis, they might stop lending to certain countries or industries that don't align with US interests, as Bessent suggested on April 23, 2025. For example, the IMF stalled a $3 billion loan to Lebanon on May 10, 2022, due to slow reforms, and in a future 2026 crisis, it could halt lending to oil-dependent nations like Venezuela if they don't diversify, redirecting funds to more stable economies. The World Bank has already ceased lending to certain sectors, like upstream oil and gas after 2019, announced on December 12, 2017, at the One Planet Summit, and in 2023, it stopped funding coal plants in South Africa, shifting focus to solar and wind projects instead. During a crisis, the World Bank could further limit lending to high-emission industries like coal in countries such as India, or even pause loans to middle-income countries like China, which some U.S. officials argue shouldn't receive WB support given its economic size and carbon footprint as of April 2025. On the flip side, the IMF and World Bank can prioritize lending to certain countries or industries to advance development and U.S. interests, especially in tough times. The IMF's Poverty Reduction and Growth Trust, with $30 billion in zero-interest loans to 50 low-income countries over the past 4 years as of 2024, shows how it can focus on the poorest nations during a crisis, ensuring they don't collapse and drag down global markets, which benefits U.S. export demand. The World Bank's International Development Association provided $36 billion in concessional loans to low-income countries in 2024, and in a 2026 crisis, it could double down on countries with strong policy frameworks, as suggested in the Nairobi, Washington Vision for May 2024, to maximize impact. The IMF could also prioritize industries like clean energy. Its $50 billion Resilience and Sustainability Trust since 2022 has supported climate-smart tech, and in a crisis, it might focus on countries adopting renewables to reduce systemic risks from fossil fuel dependency. The World Bank has done this too. Its $5 billion Energy Sector Management Assistance Program helped 1 billion people gain electricity access by April 2025, often prioritizing solar projects in Africa, which can use US tech, channeling money back to American firms. Speaking of energy, the IMF and World Bank can influence major shifts in oil, electricity, and nuclear power, which could further U.S. goals. In the oil sector, the IMF has pushed oil-dependent countries like Nigeria, with a $3.4 billion loan on April 30, 2020, to diversify away from oil, while the World Bank's 2017 decision to stop funding oil projects has cut global supply, potentially raising prices and benefiting U.S. producers like ExxonMobil. In electricity, the World Bank committed $42.9 billion to climate finance in 2024, with programs like scaling solar adding 2 gigawatts of solar power in Africa by April 2025, increasing demand for U.S. tech like smart grids from General Electric. The IMF also pushes for ending fossil fuel subsidies, $7 trillion globally in 2022, encouraging countries like Indonesia to shift to renewables, supporting U.S. clean tech industries. Nuclear power is another area of influence. While the World Bank has been cautious, it's provided technical assistance, like helping Jordan in 2023 with nuclear regulations, and the IMF recommended South Korea increase its nuclear share in 2024 to meet climate goals. By April 2025, this advice extends to Poland, which signed a $40 billion deal with Westinghouse on November 30, 2022, to build reactors, boosting U.S. exports. These energy shifts can drive money back to the U.S. by increasing demand for American tech and encouraging countries to buy treasuries to fund projects, especially if the Mar-a-Lago Accord creates uncertainty that makes treasuries a safe haven. So, what about prioritizing development? The IMF and World Bank can focus lending on certain countries or industries to move them forward. The World Bank's goal, announced on April 10, 2024, To provide electricity to 300 million people in Africa by 2030 prioritizes renewables, while its $750 million loan to Nigeria on June 15, 2024, for rural electrification supports U.S. solar tech. The IMF's $50 billion Resilience and Sustainability Trust since 2022 targets climate-friendly sectors, and both could prioritize allies like Poland for nuclear projects, aligning with the Mar-a-Lago Accord's focus on strategic industries like tech, AI, and crypto. Let's tie this all together. What does this mean for the U.S., China, and the global economy? The Mar-a-Lago Accord is a power play, shifting away from Bretton Woods cooperation to a U.S.-first approach, using tools like stablecoins and energy shifts to dominate. China faces pressure to rebalance its economy, potentially weakening its export model, while the U.S. strengthens its grip on global finance. Bitcoin and other cryptos benefit from this liquidity surge, with analysts like Galaxy predicting $185,000 by December 31, 2025, and Robert Kiyosaki seeing $1 million by 2035 if a crisis hits. But there are risks. If the U.S. overplays its hand, we could see a global crisis by 2026, pushing countries toward alternatives like China's Asian Infrastructure Investment Bank, fragmenting the financial system. What do you think? Will the Mar-a-Lago Accord cement U.S. dominance, or are we heading for a global shakeup? Drop your thoughts in the comments below, and if you found this deep dive helpful, don't forget to like, subscribe, and hit that notification bell so you don't miss our next video on FluxFolio Finance Channel. We'll be exploring the fallout of these economic shifts, so stay tuned. Thanks for watching, and I'll see you in the next one.